Hi, everyone. Chris Wiley here from Wiley Development Group. Just getting organized real quick. We'll be up and running momentarily. Just get the monitors on. Everybody get settled. Please stand by. I'm going to mute the line for just a minute. We're just coming across the top of the hour. 1 second. All right. Looks like everybody's getting in their seats. This is Chris Wiley with Wiley Development Group. Thanks for joining us today. This is the part of our webinar series for fast casual restaurant operators and investors in the space. The events coming up, I'm going to recap quickly for everybody who's just getting settled, the last 4 events, which are available on our YouTube channel. But today's event is about financing and capital to expand your development, fuel your growth in the fast casual restaurant space. We're going to talk about down payment sources and even how to get restaurants built with no down payment at all. We're going to talk about restaurant financing options to go with that equity that you need to get the deals done, and potentially how you can do restaurants with no loan at all on that store. And there's some magic to that, and it works if you have a brand. We'll talk about fueling your growth and some of the basics about how landlords will help fuel your growth, as will the tax incentives, which are now up to 100% of your project budget, the cost to put a store in operation. And then we'll close out with 4 ways to participate with us, ranging from scenarios where we help fund stores, we work with JV partners and limited partnerships, and you can become simply an independent franchisee or an area developer and control a market of your own. We've had a number of events since December. These are the 4 most popular. These are available as recordings on our YouTube channel. Just search for Wiley Development Group on YouTube. On that channel, you'll be able to watch these events if you care to. We are going to begin producing 5 to 10 minute long segments, topic by topic, so that if you're a YouTube fan, you can literally watch them like podcasts. I'm not in the podcast business, but we will fill the YouTube channel with these topics. The social media marketing event had 4 topics, which are really juicy, included some guest panelists, including Matt Platt from Driven Media Solutions, a master in the space. Our event on fast casual alcohol also had 4 key segments about the industry. We were joined by guest panelist Darren Nicholson from iPorit, who's our technology partner in the space. Those events, again, are both available on the Wiley Development Group YouTube channel. We're going to talk, or we did a deep dive event on the restaurant tax incentives. Today, I'm just going to touch on a key component as it pertains to your financing. And we, in our last month, our topic was the battle for locations, how to get prime retail locations using a multi-brand strategy. We did it 4 15-minute segments. In this event, we'll touch on that a little bit as we get going. What I'd like to do is get everybody started with a quick warm-up poll. We'll do this about 5 times during the course of this event. It helps me understand who's sitting in the audience today. If you could, grab your mice and click away. Let's start out with the first poll for the audience. And that poll is, what best describes your role in the business today? Are you an investor? Are you an operator? Are you multi-brand? Just give me a little bit of context so I can adjust the talking points as we go. Really appreciate everybody participating in the polls, and it helps us understand, even as folks in the audience, who else is joining you out there. We have seen a lot of people who are totally new to the space just checking us out and having really treating these as a way to explore the business. Thanks everybody for clicking away. I see most everybody in the audience has done so. So let's take a look. So it seems we, again, have a lot of folks who are, about half the audience is completely new to the space or new to restaurant franchising, and a mix of folks who are multi-unit operators, as well as some investors in the space. What we're going to talk about today will appeal to each of these groups in different ways. 1 second. And oops, and we yeah. 1 second. There we go. So let's move on to what the 4 topics of today are. The first topic will go just about 10-15 minutes is down payment sources, so you can get prime retail locations and techniques for getting a location with no down payment at all. Second topic is the best financing options for various types of lending programs and how you can actually build restaurants with no loan at all for the tenant improvements. We'll talk about how you handle equipment separately from the tenant improvements and how to fuel your growth by leveraging the landlords. Landlords are highly motivated to get you into their buildings and developers to build buildings for you, and how combining that with the amazing 100% tax incentives specifically for the restaurant industry can change your business. And we'll talk about at the end the 4 ways you can participate with us. We are an independent franchisee. We also are an area developer for Rapid Fire Pizza and Hothead Burritos. And you can work with us or you can work directly with the franchisors and potentially even control an entire market for those states where the market's available. With that, I have one more poll to keep everybody on task here. And I'll try to be quick about it. Thanks for playing along. What's been the primary source of the cash that you use for your down payments with the lending that you're using in your stores? Now, I realize about 50% of the folks on the call are new to restaurant franchising. Maybe you've been building other sorts of restaurants or other business concepts. I did see just a small number of people, maybe 25% of the folks here said they are multi-unit operators. So for those of you who have been using some various types of financing to get deals done, curious how you're getting it done. Thanks, everybody, for participating. I see a bunch of folks who clicked in. And it's about half and half. Tapping the retirement accounts, we're going to talk about that today, and personal savings. We meet people every day looking to get out, bust out of those corporate jobs or come out of other operations owned by other people and take the plunge into restaurant franchising. So let's talk about how you can get that done by minimizing the amount of cash that's actually required to do it. So down payments in this context are all about getting prime retail locations. Our sponsors today, and we're joined by Ray Wiley. He's the CEO of Rapid Fire Pizza and Hothead Burritos, the 2 franchisors. He's my brother. I am a store development company along with my brother Pete, who's on the camera. We decided to set out and try to become the largest franchisee of Rapid Fire Pizza and Hothead Burritos as a part of our race to 200 stores. Talk more about that in a few minutes. These are the types of locations I'm talking about financing. Some cases it's getting into buildings that are multi-tenant. It's typically end caps for us, and we're going to talk about how to get that done. For those of you who said you had tapped retirement accounts, some things are not so obvious about this. The most obvious ways are to take a withdrawal or to take a loan from your own 401k or IRA account. Pete and I actually have investors with us today that helped us build our first 2 Rapid Fire and 2 Hothead stores that are, so let's call them friends and family, that their money was all in retirement accounts. And we have partners who facilitate those friends and family investing money from their retirement accounts where they were earning, 1% on their money or 3% on their money and invest them with us. So whether it's your retirement account, which has more strings attached, or friends and family who may be willing to back you, there are ways you can do it that literally allow you to either take a loan from those accounts or move to the second topic here, which is self-directed investments. To do a self-directed investment, those need to come from third parties. So if they are friends and family that have a retirement account, they can direct their plan administrator to invest their retirement funds in your restaurant. That has restrictions. It works for people who are not involved in the business day to day. If you are involved in the business day to day and you are the operator, you need to look at using a loan from your retirement account or actually doing a disbursement. One of the counterintuitive things is that people are paranoid about making disbursements. When we launched into this, my kid sister actually put some cash up with us because they had a small nest egg and they wanted to make it go further. And they did a distribution, and that distribution had a 10% tax penalty. But the tax write-offs, the tax incentives were 10 times the penalty from that distribution. If you have not explored that, CPAs can help you with it. I'm not an accountant, but our CPAs have helped us do this, and it's very compelling why you would want to do that. We find that about a large percentage of the folks that I talk to who are interested in becoming a franchisee or an area developer for Rapid Fire Pizza or Hothead Burritos, or in working with us at Wiley Development Group, have international ties. They may be immigrants themselves. They may have been in country for a long time. They have friends and family. This is where the E2 visa investors are an opportunity to have friends and family that have high net worth move cash into the business. The U.S. government, Uncle Sam, wants that money to come into the country. And the programs for E2 investors allow them, people with a net worth of $1 million, to transfer money into the States and become an investor with you. That is suitable for a typical fast casual restaurant. EB5 investors, instead of just being a visitor, EB5 investors are folks who are really seeking to move into the country and become a permanent resident. This is the government incentive plan that was perversely exploited by certain politicians a couple of years ago, but this is the Uncle Sam's way of attracting capital into the country in exchange for a green card. Despite your politics and how you might feel about it, it's a great way for folks with international ties to help their friends and family join them in the business, irrespective of where they're coming from. Now, the key to an EB5 investor is they have to deploy $500,000 in cash, and they must work in that business. And if they're deploying $500,000, that is the entire project cost of a typical rapid fire hothead regular format restaurant. We're going to talk about our formats, large and regular formats. A $500,000 investment from a partner is only really going to work in our large format tap room or cantina locations, where the project is more in the $800,000, $900,000 range, and they would become a partner with you. The challenge with these two methods is they can be time consuming. You're not going to do your first store with them. They're suitable once you have a store open to then diversify and bring friends and family into the process. Trying to watch the clock here. We have a number of limited partners. We have built our business with limited partners, and these are typically family offices that are in the markets where we're working. They're aware of our brands. We have some niche private equity firms that have invested with us. They are looking to get into the space. They like the fast casual market segment. If anybody was watching MSNBC the last couple of days, I'm a business channel junkie. There was 20 minutes dedicated to an expose on Chipotle under the leadership of the Taco Bell executive that joined them. They've done an amazing turnaround. But most of the segment was about the strength of the fast casual sector, how the strength of the sector has allowed them to achieve amazing turnaround and to reinvigorate their growth. We are squarely in that space. You can't franchise Chipotle. You can franchise Hothead Burritos. But there are bigger firms that are focused on the QSR fast casual space. We'll talk about them more in a minute. But to attract that kind of investment, you need to be a multi-brand, multi-unit operator. Again, typically they're going after operators that are approaching 20 units, and they will get in and get involved with you. They, like us, are attracted to the tax incentives. The tax incentives allow you to produce income from these restaurants, protect that income with the tax incentives, specifically so you'll reinvest it and build more restaurants, which is good for all of us. Last but not least, the real zinger here, which I use as a teaser in the invitations, is you can skip the down payments completely. So I'll use a typical illustration, round numbers. For us to put up a rapid fire pizza location or a Hothead Burritos location that's equipped with self-pour alcohol, so not the large format, but a 3,000-foot restaurant, let's say, the total project cost is between $400,000 and $500,000. In doing that, typically we're going to have tenant improvements in that building of about $200,000, and we'll have maybe $200,000 worth of equipment. In a build-to-suit partnership, and we'll talk more about landlords in a minute, but in build-to-suit partnerships like we've established, the developer will build the building for you. They will build out your tenant improvements as part of the building. In doing so, you're simply a tenant. And their incentive to induce you to be the tenant is to provide those tenant improvements so you don't have to get a loan. We'll talk more about the consequences of this, but very specifically, you do not want to get involved in deals where they're building your improvements and then financing them back to you. A proper build-to-suit partnership is going to include them at market rents. You literally can do these projects without having to do the $200,000 tenant improvement loan, and the equity down payment, which we'll talk about in a minute in terms of size, could be a significant amount of money. This does exclude anything that can be removed from the building. So your equipment package, your ovens and your cash registers and your fixtures and fittings, all of those items get rolled up in a capital lease. The good news about capital leases is that they typically do not require equity down payments. They require first and last payments. They require great credit. They require some net worth. And they also generally are only going to be available if you're part of a brand that's got national recognition, which is why we're building out stores under Rapid Fire Pizza and Hothead Burritos. Elena, you want to cover the transition?
Right. Absolutely. Thanks, Chris. So I think we learned a lot right now about down payments using 401ks, self-directed IRAs, which for me personally has even been a very eye-opening exercise in this. But now Chris is going to take us through, what about when you do it with no loan at all? So Chris is going to talk a little bit about how Hothead Burritos did this and how we can use other loan programs to make this work. So back to you, Chris.
Thank you. With that, I want to do a quick poll for the audience. Again, we'll make sure everybody's awake here for a minute. We're going to talk about, get a sense of what type of lending you guys are familiar with, or you guys and gals that are in the audience. For those of you who have been building stores, are you using SBA loans? That's the most common way to get started. Are you familiar with large non-bank financial institutions that will provide lines of credit? Or are you just completely new to the space? In which case, we're happy to even do a private meeting with you and talk about these things in detail. Thanks, everybody, for jumping in. I appreciate everybody participating in the polls. I see about half the folks have. I'll give it a couple more seconds. Make sure everybody's awake out there and playing along. Thank you very much. All right. So I see the audience is kind of split between our group of folks here that are totally new to the business and those that have done traditional loans. Traditional loans work great. If you have a number of stores in operation, you can leverage bank financing. But when we started, and I'll say when Ray started Hothead Burritos, he had been a Subway guy for about 20 years. Ray, I know you're on the line if you're able to unmute. I like to talk about how when you first got started in Subway, the development agent actually built most of the stores and then walked you in the bank to get financed.
Yeah, actually, a lot of Subway development agents, the way they developed their areas was they would build the stores and they would just simply resell them or flip them to a franchisee or a new franchisee in the area that wanted to, become a franchisee. And it just kind of a little machine. They'd build stores to sell them and build them and sell them. And sometimes those area developers would carry the loan themselves, or they would, help you get to a bank and do a bank loan.
And Ray, when you decided to go out on your own and create Hothead Burritos more than a decade ago, one of the first watershed moments for you was, A, getting them open and it worked. That was awesome. But two was what do you call it? You get endorsed or certified by SBA?
Yeah, it's kind of, I guess it's a certification. You become listed on the SBA registry, and that takes a little bit of time to do as a new brand. But we did get it done. It took a couple years, but we are now registered. Both of our brands are, and that just makes it easier for a franchisee to come in and get a loan.
Yeah, and we've done many small business administration loans to help people cross over from their day jobs into becoming a franchisee. One of the things I learned from one of our friends at Huntington Bank, and we have many banks we work with, they all kind of compete for the business, which is great. But he once said, SBA loans, which we'll talk about here now, are great for getting started. For that first one or two, maybe three stores, the SBA loan gives you maximum flexibility. It gives you the highest amount of loan amount, thereby reducing the amount of cash you need to get your store open. But it's got some gotchas, and the gotchas are they tie up your house, they tie up any other assets you have, so you become beholden to the SBA insurance, and ultimately the banks that are involved. So as you grow, you want to move, as the number of the people on the presentation have indicated, you want to move towards cash flow based loans. So when Ray developed Rapid Fire Pizza almost 4 years ago now, we were well into the game. I think you had maybe 60 or more hotheads open. You crossed over into the Rapid Fire Pizza game. But at that point, Ray, I remember you talking to me about how the banks were so aggressive with you in a positive way that you had a lot of cash flow. You had a bunch of corporate stores. But there's real advantages in using the traditional bank financing where they're lending on your cash flow and they fund the projects, and you keep your cash in reserve. Could you just talk a little bit about your experience moving over to traditional cash flow-based bank loans and getting out from under the thumb of the SBA loans?
Yeah, I mean, there comes a certain point in business if you're, successful and you have cash flow and you have a couple of years of experience of good cash flow, then the conventional lending is great because, we deal with a lot of smaller banks and they will loan based really on credibility and obviously your credit worthiness and your credit score, but more importantly, they're just looking at simply the fact you've been in business, you've had good cash flow for a few years, and they're running the odds, and statistically it's a good risk, so they do it.
Yeah, and typically those loans are less expensive than SBA loans. Those loans may have a lower loan to value. In my example, about 80%, even as low as 70% for a bank or credit union loan. But the difference is when you do an SBA loan, let's say you need a $100,000 down payment, the bank is going to make you put that $100,000 in the bank account for that business, and then they're going to disperse it. And then they're going to begin funding behind you. Whereas the banks, in a non-SBA loan scenario, the bank will fund the project like a construction lender, and you keep your capital in reserve. You have much more flexibility, and you tend to have lower cost of funds, much more flexible, and it's the way you want to go as you grow your business. Now, we have not used these in our business today. I've used them in my business. I've been in capital markets for 25 years now. Myself and some of my partners have come over from the capital markets and the mortgage industry. And there's very aggressive lenders. You hear of companies like the Credit Suisse of the world or Blackstone or Fortress Financial. Those kind of companies will come if you have 5, 7, 10 or more restaurants, and they will compete to consolidate all that lending in lines of credit, creating even more flexibility. So I've been surprised in our conversations with large operators coming over from Subway, for example, or from Burger King or from other concepts that as they cross over to start developing our brand, they literally have been quite unsophisticated about the way they develop their restaurants. They have individual loans on every store. There's lots to deal with. Pete's on the line with us today. Here, throw Pete a softball, but Pete deals with all the bill paying. One of the things we do at Wiley Development Group is we run the back office, finance and capital markets and HR and payroll for our sponsored owner operators. But Pete, even today, we deal with that where we have, one loan per restaurant entity, right?
Correct. Yeah, you got to manage, 3 or 4 bank accounts, 3 or 4 loan payments, and it definitely gets easier if you can consolidate them. Especially from a cash flow standpoint.
Yeah, absolutely. And we have institutional partners with us today as we raise additional capital that will get much more flexible with us, and they're knocking at the door to help us expand. So again, we'll talk a little bit about how you can participate with us. So as an individual operator, you may not have the opportunity to tap into those resources. And again, these can be even lower cost of funds than the bank or the SBA loans also operated by banks. But if you partner with someone like us, you may have access to these kind of resources. One of the challenges of this is that you really need substantial assets. In some cases, they're going to require that you own the property. We are not in the business of owning the properties. We're going to talk about that in a minute. We need a lot of folks. Darren Nicholson, I believe, is in the audience today. Darren is with iPourIt. We partnered with iPourIt for our self-pour alcohol systems. Again, on our Wiley Development YouTube channel, you can see the past events where Darren was a panelist with us. We have been piloting that technology. Started last October. But as we got to know each other, we realized that Darren had a lot of folks who had a dream, were trying to build a large bar and restaurant, trying to go with 40, 50, 60 taps of self-pour alcohol. And as they went down the path to negotiate leases, they quit and try to get their financing for their projects, which could be $500,000 to $1 million projects. They quickly found out that without a national franchise brand, without a history of operating, the banks would say, sure, we'll do the money or we'll do the loan at 50% down, right? I mean, Pete, I don't think we've deployed more than $100,000 in capital into a single restaurant in the 4 that we have, right? Yeah, and I think it's even been lower than that. But in the challenge so we met a lot of these folks who are well down the road. We just talked to one a couple weeks ago who literally wrote a check because he had it in his savings of almost $50,000 to prepay his lease for 1 year. If you work with us, one of the opportunities to consider working with a brand like us in our tap room concept or our Hothead Burritos or Cantina concept is that we're pairing up self-pour alcohol in a large format where the kitchen is our branded fast casual concept, and the adult bar area is adjacent to it, so that we can leverage the brand, leverage the franchise, leverage all the support, but more importantly, leverage the credibility of a franchise brand that's got national recognition, is even ranked and rated in some of the national trade journals. And again, we've got SBA certification, so we can get SBA loans when we need them. Hard money works. Anybody who's been in business a long time will once in a while use it. It can be very high interest. It can be very short term. But often, if you're trying to get started in this business, you're trying to follow that dream, one of the challenges is that hard money party, especially private party, is going to want a bunch of equity as well as the loan. So you end up working for them, and that's not the goal of setting up in your own business. Again, as I teased in our invitation, you can skip the loan altogether. If you leverage build-to-suit partnerships, which we're establishing today because we have the size and scale to do it, you can avoid the down payment. I talked about that earlier, because if you don't have a loan, you don't need a down payment. You can avoid the loan. A simple way to think about it is if you are building a $500,000 restaurant, the loan for the project will probably have a payment. I think our loans on those projects have been somewhere between $5,000 to $6,000 a month, something to that effect.
Correct. Yep.
Right, and that's covering our tenant improvements and our equipment package. Literally half of that loan is covering the tenant improvements, so $3,000 a month. In a build-to-suit relationship, the build-to-suit partner will build those TIs out and configure your restaurant for you, and now you skip the $3,000 a month loan payment. That works as long as you're getting the building at market rent. So if you're not paying a premium for the rent, that in exchange for helping that developer or the landlord with an existing building repurpose their building, they deliver you those tenant improvements, you can now afford a more premium prime retail location, but you're paying market rents, and you essentially are getting your tenant improvements for free, which conserves your cash. You will use a capital lease to cover the equipment. As the bankers like to say, everything that can be rolled out of the building. But again, capital lease packages typically do not require equity down payments, just first and last payments. So, Elena?
Yep, absolutely. So after that, we're going to get into a really exciting portion, which Chris alluded to, around tax incentives. We're going to walk through those advantages, and then really the tenant improvements. How do you leverage your landlords to get the best deal for your money? So, Chris, go ahead and talk about how we can fuel our growth.
All right, everybody, we're going to tease you one more time with a poll. Make sure everybody's still awake out there. I see most people are still paying attention. What is your experience with landlord-funded tenant improvements? How many of you that have actually built stores out there in the audience have leveraged your landlord to get something more than free bathrooms? Is this something that you've got experience with? Is this new to everybody? Again, appreciate everybody playing along. I see almost everybody's paying attention. It puts up these scary little yellow triangles if I'm boring everybody and losing them. So thanks again for playing along with us. I see just about everybody has voted. Thanks for joining us again today. We'll try to move quickly along with the next topic. And okay, we got a few people doing worked with TI contributions and TI allocations. I'm going to talk about those separately. I've gotten a crash course from Kelly, our head of real estate, over the last year, in what the difference between the two is. I'm going to share a little bit. And we meet a lot of folks. As Ray described, when he started out with Subway, the development agents built the restaurants. And by the way, we're embracing a model like that in the future. We're not doing it today, where we're looking to work with our area developers to stand up the restaurants and then allow franchisees to take over the built restaurants on a turnkey basis. Again, for those of you who are new to it, hopefully this will get your propeller spinning about how you can get this done. We talked about no down payment, no loan, minimizing your cash tied up in the business. That's all about ROI to me. I'm a capital markets guy. It's about cash-on-cash returns. So to really leverage landlord relationships, you need a multi-brand strategy. These are the four formats that we are considering today, and there's a very specific reason for it. I've been talking about build-to-suit, where they'd stand up a new building. Well, there's a very large opportunity across the country caused by the Amazon effect. Most famously, the Payless shoe stores, bankrupted and many 3, 4, 5,000 square foot buildings available all across the nation. The last big one before that I recall, aside from Sears, which would be too big for our projects, would have been the sporting goods. One of the big sporting goods chains. I actually knew people involved in that bankruptcy. They vacated tons of 4 and 5 and 6,000 square foot buildings. Those empty retail buildings are standing out there. They are not viable for traditional quick service restaurant concepts, and most big box restaurants are not suited for those configurations. So we are employing 4 basic formats. We're in the process of developing our first rapid fire pizza and tap room. That's going to be a 5,000 foot format in a 6,000 foot building in Findlay, Ohio. It will feature a large 60 tap system in the middle of the restaurant, as you see in the picture. We also, Ray just opened a corporate store, which is a Hothead Mexican Grill and Cantina. This particular location was opportunistic. It was only about 3,000 feet. It was in the first picture I showed on the screen. It's a beautiful location, but we are planning for Wiley Development Group, Pete and I, to build 4,000 to 5,000 foot Hothead Mexican Grill and Cantinas, especially having the option to go rapid fired tap room or Hothead Mexican Grill and Cantina allows us to get around pizza or Mexican restrictions on the retail development projects, right? You go look at where these Payless shoe stores are, there could be a Pizza Hut or a Domino's or a Papa John's or something else in that shopping center. If there's something pizza in that center, there's going to be a restriction, so we can flip the coin and go with Hothead. If there's a Mexican restriction, we can go with rapid fired. Interestingly enough, Ray shared a story about a Hothead burrito store where a very traditional family Mexican restaurant took an old building in the shopping center behind his Hothead store. It had zero impact on the Hothead, right? We are in a fast casual space. We're leveraging the fast casual alcohol to really drive the date night concept and weekends. But back to leveraging your landlord. You can go with the 2 large formats to capitalize on getting landlords who are holding these defaulted properties to give you material financial incentives to get that building converted. Or you can take one of those concepts here in the bottom left and split the building down and put a large format store combined with a regular Hothead or a regular rapid fire with no alcohol. And for those markets where liquor licenses are too difficult to attain, then you could split that building down into 3 components, or you can work with build-to-suit partners to have them put up a 2 or 3 unit building. The key here is controlling multiple brands. If you have multiple brands, you control the building, you become a single counterparty. If you don't have the girth, the depth, the financial capacity to do that, you can partner with us to get it done. And our goal is to partner in markets where we have area developers, which we'll show you in a minute. I want to cut through these quickly. The most common TI contribution is, let's say you're renting a building at $30 a foot. Maybe they give you $5 a square foot in contribution. That is money that is just given to the contractor. They pay it directly or pay it as a reimbursement. That typically might get you an air conditioning system or air conditioning upgrade, maybe some power in bathrooms. That is not going to materially impact your project. It is important and you want to get it. It's free money. And folks like Kelly Gray, who heads up real estate at Rapid Fire Hothead, will get that negotiated. But there's also tenant improvement allowances where the landlord is essentially loaning you the money. Loaning you the money could be the entire cost of finishing out that restaurant. The downside is now you essentially are paying a premium for the rent. You have to repay that over, say, your first 10-year term. There is one reason to do it, and we are considering it on certain locations, and that is because, let's say I'm converting a 6,000 square foot building and putting 2 restaurants in it, and that project is $1 million. If the landlord will give me a $200,000 TI allowance and amortize it over the first 10 years of the loan, the bank, under the right circumstances, will consider that my equity in the project. And now I only need an $800,000 loan, and I only need 10% of an $800,000 loan to get my deal done. There are reasons to consider both. Again, the TI, or the tenant improvement allowance, which is an amortizing loan to the landlord, basically, is an expensive way to do it. But if you are limited on capital, it may make sense for you. The key thing is that no landlord out there, and to my example of the folks that are dreamers trying to do restaurants and bars, landlords are not going to do these types of very aggressive incentives unless you have a brand and you've got the credibility of the brand. And that's where what we're leveraging is what Ray has built at Rapid Fire Pizza and Hothead Burritos, and the familiarity with the landlords. They literally have standard lease agreements with the top tier landlords that control probably more than 50%, as much as 70% of the real estate across the country. We talked about this. I'm going to keep moving quickly, but if you do a build-to-suit partnership correctly, which we have several partners that are very aggressively courting us for our business, and we can help you engage with them, then you should be able to get very high-profile prime retail locations at the cost of what you would pay for an inline store. Anybody who's seen Subways over the years, and Ray was a big part of it, we found that those inline stores, or sorry, the end caps perform materially better. Ray, are you still on the line?
Yes, I am.
Ray, could you comment about what you learned when Kelly joined the organization and we started moving from taking inline stores to moving to the end caps, what the performance difference was?
Yeah, I could just tell you, Kelly's been in real estate for many years and done a lot of deals with a lot of national brands. And, one of the things she really, I'm going to say, kind of pushed us in the direction of the end caps and the freestanding buildings, as opposed to what we call inline buildings, which is inline spaces, like in a Walmart plaza. You get a bunch of retail stores in a line. But being on the end cap, we've seen sales increases as much as 20 or 30% by being on that end cap. Same plaza, same city, just being on that end cap gives you more visibility to the consumers that are driving by. And we're not exactly sure what causes it, but it does cause the sales to be higher in those stores.
Yep. And one of the advantages of doing a build-to-suit relationship where the landlord is building it out, and Pete, a question for you or comment for you would be great. Pete is part of the franchisor. He's an investor with me and a partner in Wiley Development Group, but he's been with Ray for many years, and he has lived through opening stores, right? You'd like to talk about the 100-store checklist, but what is if we can get the build-to-suit partner to do a turnkey arrive and drive, could you just describe the level of effort it takes a new franchisee to try to figure out how to open a store the first time?
Yeah, if you've never opened a restaurant, it's quite an eye-opening experience. For both our brands, we have at least a 100 checklist item or 100 item checklist just to hit your bases. That's just getting the doors open. Anything from your power to your water to building to parking lot maintenance, cutting your grass. There's just all kinds of different things that you don't ever think about having to deal with. So we really try to make it simple, and that doesn't even touch marketing, which is mainly what I focus on. So then you got to worry about marketing.
And how many people are in the team at corporate that help in that getting the store open 100 item checklist?
We have one key person for each brand, and there's 2 or 3 people that help follow up with the franchisees on both sides.
Yeah, and something that I'm proud of and that I like doing with our brands is that we're still boutique, right? This is still I wouldn't call it a family business, although Ray and I happen to be brothers, and Pete's a brother as well. We've been brothers like forever. But we are not a big corporate scenario. People who get involved in our brand, they get to know everybody in the system. You get to know the real estate development people in Kelly's team. You get to know the construction people and the architects. This is not some big arm's length deal. So we're excited that when people join the system, they become very intimate. They know everybody on a first name basis and can actually text message with them, although that's sort of the bane of our existence. But again, by doing build-to-suit partnerships, you can get high-profile retail locations for essentially the cost of inline locations, and the turnkey arrive and drive can dramatically streamline your ability to get stores up. The downside to actually having buildings built for you, which is an opportunity for all of us, is that it takes about a year from the time you select a retail pad site by a Kroger's or a Meijer or a Target or something like that to get the building built and open. So in the meantime, our strategy at Wiley Development Group is to focus on those vacant prime retail big box locations that we can convert for our purpose, and the tax incentives are what build upon this. So we've talked about how to get it done with no down payment. We've talked about how to get it done without having to get a loan for the tenant improvements. Now let's talk about recycling capital. The tax incentives that passed last year are amazing. They built upon very traditional tax incentives that have always been there. And what it really means is if you have and this is just an example, just to make the math easy, think about it on a whiteboard. If you build a store a year at a capital investment of $500,000 a store, and after your accountant does their magic with amortization, depreciation, all that good stuff, the store has a net profit of $100,000 a year. Opening that store under the current tax incentive structure will create, if it's $500,000 project, it'll create $500,000 in tax write-off. That could literally shelter that $100,000 a year for 5 years. If you open a store a year for 3 years, just 3-store plan, you will shelter over $1 million in the first 4 years and still have $300,000 in tax-free income ahead. We don't know how long this will last. It was passed by the current administration. It's good for at least 2 more years. We want to build as many stores as humanly possible. The government wants you to do it. The government wants you to recycle that cash and create jobs. These are just, again, building on traditional amortization depreciation, the old Section 179 accelerated depreciation, which was an incentive to open businesses. The Tax Cut and Jobs Act simply jacked it up to 100% of a qualified investment, but there's one critical requirement. You cannot own the real estate. You can't be invested in the company owns the real estate. This is why you keep hearing me talk about real estate and landlord partnerships. We are capitalizing on these incentives, and you can capitalize on them too. And the tax incentives can flow through to the owner-operator who's operating the store. Those are direct negative incomes. My son, who helps operate a couple of our stores, is one of the owners, and he was trying to do a mortgage application recently, and the bankers were stunned that he had literally negative income for the last 3 years. Pete and I think we experienced that. This is because we keep building restaurants, right? Ray told me for years, never stop building restaurants. It's not that we're manipulating the tax system. We are doing what the government wants us to do. We're creating jobs. Investors who are active in the business, like Pete and I are at Wiley Development Group, we are the back office. We're doing banking and capital markets and HR and payroll and marketing. Those depreciation losses can pass through to us on K1s. For our limited partner friends and family and institutional limited partners, they do get the benefit of the tax incentives, but they do it in a different way. This gets into accounting, but it literally, they can take passive losses against passive gains from other investments, assuming they're making money somewhere else. The operator's dilemma in all of this, now that we've showed you how to do it without down payments, potentially, or very small down payments, without loans or just limited loans and capital leases, we've showed you how to do it, and I think I've got the message across that to really do it effectively, you've got to control multiple brands. Most operators like us don't want to drive more than 50 miles. Pete and I are not building stores in Chicago, but we may invest with an operator who is because we don't want to drive to Chicago, right? My son operates our stores in Northern Ohio where we did the pilot, and he doesn't want to drive more than an hour in one direction. I use this picture because Ray started out in Dayton, Ohio vicinity, building or doing subways for many, many years. Subway, as most people know, pretty much overdeveloped. But here's a map on the left of all the subways in Dayton when I Googled it. There are 27 hothead burritos. Some are corporate, some are franchisees, all strong in that market and expanding throughout the country in about 12 states now. My illustration here is that you could cross over from Subway or Burger King or some other brand, and you can put hotheads right across the street. That's how Ray did it in the beginning. He put hotheads next to the Subways in his buildings with, cooperation deals with landlords. When he launched Rapid Fire Pizza about 3 or 4 years ago, did the same thing. There are now, Ray, I believe, somewhere 8, 9, 10 Rapid Fire Pizza locations in the vicinity of Dayton. You notice those all lay over the top of each other. If you have a multi-brand strategy, you can literally stop turning down those tips from landlords and developers and city councilmen who tell you about the new project that's going in. Now you can capitalize in it because it's like playing cards. Do you want to put a rapid fire there, a hothead there, or your current brand there? It's a multi-brand strategy. Lena?
All right, as we jump into our last segment, which again I think is really important because it talks about all the different ways the different participants on this can participate. But before we jump in, also please at the end note that all of this will be on YouTube, and we're going to do, as Chris mentioned, we're going to have shorter versions of this so you can share with friends or maybe other interested investors that you want them to get up to speed. So again, we're going to launch into the 4 ways to participate, which I think is, again, very unique to these brands that we're talking about today. Go ahead, Chris.
Thanks, Lana. So one more poll for the audience. Make sure everybody's still awake. I see most people are hanging in there with us, paying attention. Thank you very much for not doing your email through the whole thing. What is the primary factor limiting your business or your growth for those of you who are in the business? And there is a line there for those of you who are not in the business yet or just exploring. But what has been keeping you from getting it done or keeping you from opening restaurants faster? I know what Ray's answer is. Thanks everybody for voting and showing. Ray, I was just teasing. I know you're passionate about the number one limitation in growing the business is what? Prime retail location.
Locations and employees sometimes.
Yeah, that's a new problem in the last couple of years. At the unemployment rates we have, it is really a challenge. So there we go. So let's see what everybody says today. Current brand is saturated. Well, those of you who are landlocked by your brand being saturated, you're the folks we're excited to have. We're excited to have everybody here today. But if you are landlocked, then that is an immediate opportunity for all of us. Those of you with limited capital to invest, if you have the operational capacity, I'm going to talk about how we can work together. And if you are limited on operating capacity, like Ray just alluded to, the unemployment challenge, we have a way that potentially can even help solve that. So with that, I'm going to jump into the 4 ways to participate. I'll go through these each in detail. We'll knock this out in 10 minutes. But in the first scenario, we are willing to step in and help fund the equity down payments for qualified operators. I'm going to talk about how and why. And we also use that mechanism to overcome this challenge of recruiting qualified store management. Ray, how many rapid fires you opened last year? Was it 8, 9, 10?
That was 2017. I think we had 9 personal stores.
Okay, 2017 opened 9 stores. Yeah, and literally anybody that was in the management team or a shift leader had an opportunity to become a general manager, right? So Wiley Development Group, we're embracing a sponsored owner strategy. It can work for people in your team who want to grow into that 3 to 5 store plan, or for qualified, seasoned operators crossing over limited capital. Joint venture market partners are folks who have stores in another market. Those of you who are landlocked, we are willing to co-invest with you. Rather than you doing a couple stores, let's build 3 to 5 together and you operate. We'll help with the capital structures. The joint venture limited partners, we'll go into a little more detail. They can help in both of the other 2 scenarios. The sponsored owner operators and joint venture market partners, we lead the investments. Our limited partners work with us together to get into the game without having to leave their day jobs. And ultimately, you can be a completely independent area developer or independent franchisee working directly with Ray and the corporate team. Let's touch on this just a little bit. Sponsor owner operator was built. It was modeled after the pilot that we did with my son, which was a 5-store plan. The idea is that you have all the qualifications in the business, whether you're working for us today or it's a manager working for you today, that you want to help them get a start out into a business that you can own a piece of the equity in. The idea is we will either provide all of the down payment equity or some of the down payment equity in participation with our limited partners. So we'll take care of the equity, you run the restaurant. I like to say, don't run out of food, give great customer service, represent the brand, and watch the bottom line, and we will give the sponsored owner operator the opportunity in a 3 to 5 store plan to build enough equity that they can build stores without us in the future. Everybody wins. The joint venture market partner, this is best suited for folks like those of you who responded that you are landlocked. If you can't build any more of your brand in your market, consider building either or both of our brands in your market. To help you accelerate that, we're willing to co-fund those deals together. We're working on a number of these opportunities around the country. The objective is to accelerate the growth of our brands together. My goal, as I said, along with Brother Pete, is to own a piece of as many restaurants as humanly possible when we reach that milestone of 200, which is our goal. We'll talk about that in a minute. This is a partnership program, though, for existing operators who already have supervisors run around in the market. who know the landlords. But, for example, a lot of Subway guys are cash strapped. I have a friend that has 9 Subways. He's barely paying the mortgage on his house with 9 Subways because the volume's collapsed on him. There are people challenged in other brands. So he doesn't have the money to go build more stores, but he has the operational capacity to do it. Joint venture limited partners are, again, like friends and family, like we started with, and then we've expanded to institutional partners who like the fast casual space. They do not want to take on the risk of being invested in a single restaurant. They want to invest across a portfolio, and they want to build a portfolio. Many of these folks are out shopping for 5, 10, 20, 30-unit operators where they can buy into a chunk of the operation. We're giving them away on a programmatic basis to be invested in multiple stores as we scale the brands. There are opportunities for these folks both in the ownership of the restaurant business, co-funding with us, and completely separately, our real estate development partners in some cases are willing to entertain real estate investors who co-invest with them. You can join us completely independently as an area developer or a franchisee. That's why Ray's on the line. Ray's organization, Rapid Fire Pizza Franchising, Hothead Burritos Franchising, are 2 independent franchisors. Pete and I, are an independent franchisee, just trying to build a bunch of stores. The gold states are states where we have active area developers in one or both brands. There are still opportunities. The area developer in Texas, for example, covers the Dallas-Fort Worth and kind of North Texas market. There's still opportunities in the southern half of the state. Florida, we have rapid fire and hothead developers there. California, there's only rapid fire. We're entertaining a couple of hothead developers. The green states are states that are comfortably within the supply chain. They're absolute priority for us. They have a lot of population that is familiar with the brands because of proximity to the states where we have stores open. All of the blue states are currently licensed. The point of this is you can join us as an area developer. There are very few emerging brands that do, where top quartile stores do $1 million a year that are recognized on the national stage where you can go control an entire market. If you were in the Subway system and you watched the lifestyle and the financial capacity of your development agents as they grew their businesses, this is your chance to be a development agent. We just happen to call it an area developer. If you're like a gentleman I spoke to in California yesterday and you simply want to put up 4 or 5 stores in a market you control and don't worry about anybody else, we're good with that too, and we'll even consider co-investing with you on the Wiley development side of the business. We are here in a race to 200 stores. We'd love for you to join us. We hit over 110 stores, and that's to Ray's credit and his team, because I didn't get involved, actively in terms of investing in stores till 3 years ago. We have worked together for 20 years across multiple brands. If anybody remembers Skyline Chili, we were involved in that many years ago. This today is a very real race. 110 stores in 12 years. We're opening, I just checked it, so we opened about 1 store per month per brand this year. Looks like we'll be able to maintain that pace through the end of the year and beat it next year. We are more than halfway to 200 stores. I'm focused on 200 stores because I'm 56 years old and I don't want to do this for another decade. I want to have some fun. I want to help create wealth. Keep laughing. I want to create wealth for our general managers by making them sponsored owner operators. I want to co-invest with my capital markets resources and other operators who have solid operating histories. We together want to accelerate the attainment of that 200 units, because at 200 units, the game begins to change. Very few restaurant franchisors that try ever get to 200. When you get to 200, you begin to attract the attention of people like Darden and Rourke and KKR and the big investment groups. We want to own a piece of as many restaurants as possible when we get there, and we believe we got a fighting chance of being there within 3 years. So if you want to join us for the race to 200 stores, then you probably care a lot about AUVs. For those of you who are new to the business, I'm talking about average unit volume. Some people talk about it annually. Some people talk about it weekly. Our goal is $1 million stores, $1 million annually, nominally $20,000 a week. Let's see, I'm looking at the actual numbers from 2018 in Hothead. Top 10% were $1 million stores. Top 50% were above 750. We just began experimenting with sell-pour alcohol in that brand in the stores where we experimented. Again, still very much a pilot. The percentage of sales for alcohol went from bottled beer and wine, which has been our experience across the brands, at maybe 1% of sales, barely worth the liquor license, to 5% or even more. Did we get as high as 10% in the cantina? I realize it's still very much an experiment.
Sorry, muted. When we first opened, we were hitting 10 with both rapid fire and hothead as we brought in the self pour. So.
Yep. Yeah. So again, it's a grand experiment. We're trying to really cultivate date night on Friday and Saturday nights. We're full of TVs, so we're cultivating the sports audience who drops in. It's slowly changing the culture. It is a marketing challenge to educate the audience. If you haven't had full alcohol, that you have alcohol. But our goal is to drive our AUVs up. This is where the AUVs are today. This is better than more than 3 dozen fast casual concepts that are out there in the market today competing for attention. And we are right on the cusp, nipping at the heels of the traditional QSR fast food that you would have seen in freestanding restaurants. And we're committed to doing everything humanly possible to drive up AUVs on a sustainable basis. Rapid Fire Pizza is the same physical footprint, but is a more complex operation. There's more moving parts. I like to say this is like the not fuel-injected Porsches of old, right? You need a real crew. It takes 5 people to get through any kind of a rush. A hothead you can run with 3 people. But as you notice, the AUVs are very similar. We're trying to get that number up and sustained above $1 million. We are still better than 80% of the people in the space where there is any reasonable opportunity to get control of a market. So what my appeal to you is today, if you're landlocked, if you're looking at getting into the business, there is an opportunity to control a city, multiple cities, a region, or certain low population states, maybe the entire state. You can get in with this as an area developer, and here's why area developers matter. Area developers, number one, only Ray can license area developers. Pete and I are an area developer, and we are a store development company. If you take on a market like Chicago, or a market like Houston, as the area developer, Ray and his team support you. They are the support system. Pete happens to run the marketing. They are the marketing operations, store developer, store opening support operations. At Wiley Development Group, we're here because we could help financially partner with you and arrange financing and arrange some equity and things like that. But irrespective of whether you do it with us or do it directly with the franchisor, you have an opportunity to build a long-term annuity revenue stream. The area developer is an extension of Ray's business into that market. You are the support team. Your job is to recruit and develop franchisees in that market, to oversee those franchisees. It is a long-term play. It is a long-term annuity revenue stream because the royalties, so long as an area developer is doing their job and building stores and signing franchisees with everybody's help, then the royalties go on for the life of the restaurants. I'd close out with the idea that Ray looked hard at the early movers. A decade or more ago, he looked at what Chipotle and Qdoba had done, and he said, I can do that. And he did it. We executed it with Hothead. We doubled the amount of ingredients, came out with crazy range of sauces. We go from mild to wild, as Pete trademarked. And you can franchise it. You can't franchise Chipotle, right? And systems like Qdoba are pretty much licensed out. You can join our system, control your market, and do it. When Ray launched Rapid Fire Pizza, while I was flying around the country in my consulting business, he was flying around the country looking at all the early places, Blaze, Mod, Pi 5, Piology, 1000 Degrees. We looked at what they were doing, and we realized where their Achilles heel was, and it was speed. It was velocity. Those chains have craft pizza. In some cases, great product. What we can do with us, they're already licensed out in most markets. You can control a market with us. We can produce more pizzas per hour. We think our product is better. It has more variety, more sauces, more fun. And we are going into sell for alcohol with a big commitment because we believe the fast casual market has attracted an audience away from the Red Lobsters and Applebee's and TGI Fridays. But those people who are coming down market, so to speak, coming out of a restaurant or a waiter, server, table service environment to get fast casual, if you want to grow your business with them, you have got to have beer, wine, cider, cocktails, or as we're doing at the Cantina, we're selling the heck out of margaritas. People love the margaritas. We're selling so many margaritas, we put margaritas in a rapid fire location. It actually did fairly well. So we're changing the game in fast casual. We'd love to have you do it with us. We're happy to give you a private briefing. After the event, you'll get a link to this, or if you're watching the recording, you can share the recording with your friends. We look forward to the opportunity to speak with any of you individually. Again, check us out on the Wiley Development Group Facebook and or Wiley Development Group YouTube channel. You can watch recordings of these events, and we'll be producing the equivalent of a podcast series for folks who want to just watch sound bites of these or share pieces with their friends. Thanks, everybody, for joining us today. It appears we finished 1 minute early, Elena.
Yeah,
Thanks, everybody, for playing along. Thank you. Have a great day, everybody, and feel free to write back to Elena for the invitations or to Ned on the screen, and you should receive both a link to the recording if you want to share it with your teammates. We're happy to provide private briefings for anybody on an individual basis. Thanks for joining us.
Thanks, Chris.